I want you to think about all the years you spent working. You got up early, you pushed through the stress, you sacrificed, and you saved. And you did it all because you wanted to cross that retirement finish line and finally feel safe. Finally feel secure, but I am here today to deliver a reality check that almost nobody tells you until it is too late. You think that when you retire, you stop paying taxes. You think Uncle Sam throws you a party, pats you on the back, and says, "Great job, you're done." No, he does not. The absolute biggest mistake, the trap that destroys financial freedom for millions of retirees, is the belief that taxes vanish the moment you stop collecting a paycheck. I am telling you, if you do not wake up to the truth about how retirement taxes actually work, you are going to watch your hard-earned nest egg disappear faster than you ever imagined. Let's address the real problem here. When you were working, tax planning was simple. It was automatic. Your employer took the money right out of your paycheck before you even saw it. But in retirement, you are the boss. You are the paymaster. You have to decide where your income comes from. Is it Social Security? Is it your traditional 401k? Your IRA? Your Roth? And here is the question that should be keeping you up at night. Do you actually own the money in your retirement accounts? If the bulk of your money is sitting in a traditional 401k or a traditional IRA, I want you to repeat after me, that is not all your money. You are co-owning that account with Uncle Sam. Every single dollar you put in there was pre-tax. You got a nice little tax break decades ago, and you felt great about it. But Uncle Sam was just playing the long game with you. He let your money grow, he let it compound, and he did it because he knew that when you finally take it out, he is going to take his cut. When you withdraw money from a traditional IRA or 401k to pay for your groceries, your travel, or your property taxes, the IRS treats that money exactly like ordinary income. It is taxed at the exact same rates as a standard salary. It is not taxed at lower capital gains rates. It is ordinary income. And that brings us to the fear that gnaws at the gut of every single person approaching their 60s and 70s. The fear of running out of money. The fear that you will do everything right, yet still end up broke because inflation and taxes eat you alive. You need to understand the concept of tax brackets. For the current tax year, the standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly. And if you are 65 or older, there are extra senior deductions and new tax rules that give you a slightly higher shield. But once your income goes over those thresholds, the brackets start ticking up, 10%, 12%, 22%, 24%, all the way up. If you blindly pull $80,000 or $100,000 out of your traditional IRA in a single year because you want to pay off your mortgage or buy a beautiful RV to travel the country, you could accidentally push yourself into a much higher tax bracket. You are triggering a massive tax bill completely by accident because you didn't plan the timing of your distributions, but it gets worse. Oh, it gets so much worse, and this is what trips up almost everyone. Let's talk about Social Security. You think Social Security is tax-free? For many of you, it is not. The IRS uses a special metric called combined income to determine if your benefits are taxed. Your combined income is your adjusted gross income, plus any tax-exempt interest, plus exactly half of your Social Security benefits. Listen to these numbers carefully. If you file a joint return and your combined income is between $32,000 and $44,000, up to 50% of your Social Security benefits can be taxed. If your combined income is more than $44,000, up to 85% of your Social Security benefits can be subject to federal income tax. For single filers, those thresholds are even lower, just $25,000 to $34,000. Think about that. A modest, middle-class retirement income can trigger a tax on the very benefits you spent your whole life funding. He says, "I've waited long enough for my share." You are legally forced to start taking money out of your traditional accounts every single year, whether you need it or not. If your account grew beautifully over the years, your mandatory withdrawal could be huge. And that huge withdrawal gets slapped with ordinary income tax, which can instantly push your ordinary income higher, which then makes your Social Security taxable, and, here is the ultimate kicker, it can even raise your Medicare premiums. It is a domino effect of expenses, all because of a lack of a tax strategy. So, what is the actionable takeaway here? How do you protect yourself? How do you stand up and say, I am in control of my financial destiny? You must create a tax diversification strategy right now. Before you retire or early in your retirement years, your goal shouldn't just be saving money. Your goal must be controlling your taxable income in retirement. You do this by having 3 distinct buckets of money. Bucket number 1 is your taxable bucket, your checking, savings, and standard brokerage accounts. Bucket number 2 is your tax-deferred bucket, your traditional 401(k), S and IRAs. And bucket number 3, my absolute favorite, the one I talk about constantly, is your tax-free bucket, your Roth IRA. Money inside a Roth IRA grows completely tax-free, and when you take it out in retirement, it is 100% tax-free. It does not count toward your tax brackets. It does not trigger taxes on your Social Security. It does not force you into required minimum distributions. It is pure financial freedom. If you are currently in your 60s, retired or getting ready to retire, and you find yourself in a lower tax bracket before your Social Security or RMDs kick in, you need to look into a strategy called a Roth conversion. This means intentionally moving money from your traditional IRA into a Roth IRA. Yes, you will pay the income tax on the amount you convert today. You pay the tax now so that your money can grow safely, securely, and completely out of Uncle Sam's reach for the rest of your life. Do not leave your retirement to chance. Do not let fear dictate your actions, and do not let ignorance strip away your wealth. You have worked too hard to let taxes steal your peace of mind. Take a look at your accounts, map out where your income will come from, and build a plan that keeps your money exactly where it belongs, in your pocket. Stay safe, stand strong, and protect your financial future.